Hello, my name is Trevor Noren, Investment Communications Strategist with Wellington. For 40 years, Future Themes has been instrumental in shaping the firm's long-term investment strategy. The question at the heart of the initiative has been a constant. What are the structural trend lines that will shape markets, societies, and economies over the next 5 to 10 years? Future Themes leverages the firm's breadth of expertise to find answers and deliver actionable investment insights. The research is done, and now it's time to present. We kicked off with a sit-down with Dara Dunn, the leader of this iteration of Future Themes. He and I discussed the architecture of the research effort and the key top-line insights from each of our 4 areas of focus, the 4 S's: sustainability, systems, society, and science. Last week, we drilled down into our first S, sustainability. Today, we tackle the second, systems. Politics, technology, and demographics are all simultaneously challenging the financial system status quo and the institutions that govern that status quo. Will COVID prove an accelerant of disruption? How far will blockchain and cryptocurrencies go in reinventing the plumbing of markets? Will the dollar remain the world's reserve currency? They are questions vital to the future of global investment dynamics, and we've brought together an incredible collection of experts to debate. So Nanette, take it away.
Thanks, Trevor. My name is Nanette Abahav-Jacobson, and I'm a multi-asset strategist, and I'm delighted to be joined by Martin Harvey, a fixed income portfolio manager. We are at a very interesting crossroads coming out of the pandemic, which could affect global economies and global markets for years to come. Governments are certainly less interested in reducing debt and warding off inflation, and more interested in employment and widening the social safety net. So Martin, I know that you've been thinking about these themes for a long time. Can you tell us why we might be at a tipping point over the next few years?
Yes, hi Nanette, thank you. Yes, certainly since 2008, we've noted a persistent rise in government debt levels, alongside in more recent times something of a degradation of institutional stability in developed markets as populist themes have infiltrated mainstream politics. Mostly this has shown up in political risk indicators, but in some cases, more traditional governance metrics, which often are seen as sort of the definition of what is a developed market versus an emerging market, have started to deteriorate in some areas. And so we're seeing these traditional emerging market features coming through in developed markets, but with limited concern for developed market investors so far. And why has there been limited concern? We feel that's because central banks have been able to stamp out any market volatility, and we've had periodic crises over this time period. But because there's been a general lack of concern about inflation for central banks, they've effectively had a singular objective to try to maintain market stability in order to justify their growth objective effectively. Good examples of this: in 2012, we had the Eurozone sovereign crisis, where the central bank eventually came in to backstop sovereign debt, and have bought a lot of sovereign debt since then. But an even better example, I think, is in 2020, where policymakers moved with both a breathtaking speed and magnitude in order to shore up markets during the coronavirus pandemic, allowing a big market drawdown to be effectively rebound within a matter of months, despite still very weak macro fundamentals at the time. So you might ask, what's the problem here? Policy seems to be working with relative perfection. But I think where the problem comes is where this assumption of no inflation concern that we've had over the last 10 years starts to turn around. At this point, central banks may need to reconsider that uber-stimulative policy. And so we're really interested in identifying the conditions that might force central banks to reconsider this blank check approach to stimulus. If we did reach that point, I think it could be quite problematic for markets in general. So with this in mind, Nanette, I'm wondering how you see these concerns filtering through to risk assets and equities and markets in general yourself.
Right. So, everyone would admit that the developed markets returns, developed market equities have been excellent over the past decade because of the conditions you described. The MSCI World Index has returned on an annualized basis 10% per year over the past decade. But I sense that investors do have a sense that there's been a deterioration both in political stability and in the omnipotence of central banks to solve every problem. And an example of this, I think, was in 2016 in the UK, which you're very familiar with, which is Brexit and the market turmoil that took place then. So just to repaint the picture from that time, the Bank of England was cutting rates and doing a lot of QE to cushion the economy in a period of heightened uncertainty due to the Brexit referendum. Now, this was all fine, but what happened is the Bank of England actually lost policy flexibility because the currency plunged and inflation spiked. So the Bank of England had to retrace their steps. They had to acknowledge that inflation was actually a problem because the currency had plunged and there were capital outflows. And so they lost policy flexibility in that instance. In 2016, the UK equity market underperformed MSCI World by 8 percentage points. So that's the type of concern, and it's the kind of market behavior that you would not generally expect from a developed market and looked more like an emerging market. So that's the type of scenario that we could see occurring more often, given the fact that there's more dependence on fiscal policy to smooth out social inequities, and also, as we've seen this past year, enormous debt issuance in order to revive the economy. So a lot of fiscal stimulus. Now, Martin, I want to talk a little bit about currency, and the US dollar has this preeminent role in the world of reserves. And I'm just wondering if you have any concerns about dollar supremacy, US dollar supremacy, and might you see the dollar weakening over the coming years?
Yeah, sure. In our search for the conditions that might undo this central bank dominance, certainly FX is one channel which can expose it very quickly. And so you mentioned that example of the UK in 2016. There have been other single market examples, but what if this happens in the dollar, which, as you say, is the global reserve currency? And this could have wider implications for markets in general. And so why is the US at risk here? Certainly in our screening process, the US often shows some of these emerging market characteristics, but is often afforded a special sort of pass because it's the reserve currency. But right now, given that massive stimulus that you mentioned, the US in particular faces a twin deficit problem. That's a combination of fiscal and current account deficit, the combination of which is greater than we've seen before. And whilst that's happening at the same time as interest rates are very low, that's historically been consistent with a depreciating dollar. And so far, actually, markets have taken that as a positive and has been seen alongside risk asset appreciation. But where does this problem become more of a problem? If that depreciation starts to speed up, then given these two large deficit problems, foreign investors may begin to question whether they want to hold as many US dollar assets and start to exit those positions, therefore pushing the dollar down further. This can lead to a spiral with higher inflation expectations and higher long-term bond yields, putting the Federal Reserve in a bit of a bind where they have to make a decision whether to put in more liquidity into the system to backstop the bond market and stop yields from rising, or acknowledge that inflation is becoming a bigger concern and try to stabilize the currency in a way that the Bank of England had to do in 2016. At that point, the market that has taken a lot of positives from the central bank's approach so far may begin to question whether those positive connotations are still valid. You know, and at the broadest sense, I think the potential outcomes over the next 5 years associated with these dynamics are quite broad compared to what we've seen in the last 10 years, especially given the big shocks that we've seen on the financial system in the last 12 months in particular. And so, Nanette, how do you think investors should adapt to this changing environment right here?
Well, I think, as you rightly pointed out, Martin, the distribution of outcomes is greater both in equity and credit markets. And so that translates to a higher risk premium. So the first thing that I would advise investors to do is revise their framework, their risk framework for assessing credit and equity markets and incorporating some EM metrics. You want to look at the debt burdens of these countries, of developed market countries. You want to incorporate policy flexibility, both on the fiscal and the monetary side. And you also want to look at where there are economic imbalances. You talked about the current account. That is a particular one that we would emphasize. Now, what the impact, I think, on credit markets is pretty negative in this scenario. First of all, if you have rising inflation, you would have rising government bond yields. If you have more government debt issuance, that also puts pressure on government bond yields. And of course, if you have higher yields, it increases the corporate default probabilities. And therefore, not only do you have yields rising, but you have credit spreads under pressure and widening as well. So not a great scenario for credit. Now, the outlook for equities is a little bit more nuanced. So on one hand, it's definitely more negative in the sense that you have higher discount rates, which means a higher equity risk premium and therefore lower equity valuations. But there is one silver lining, which is if you have the currency declining, that would favor exporters. And so those would be the types of industries and companies that you'd want to emphasize. Now, the last thing is also somewhat nuanced, which is if the politics in a developed market country starts shifting to populism, you're going to have a much less certain regulatory environment. And so industries that tend to be highly regulated, and I would include in that banks, utilities, telecoms, these industries are going to be in the crosshairs of regulation if the government starts implementing tariffs or caps or things that are, again, something that we accept and expect in emerging markets, but not so much in developed markets. So, Martin, I'd like to know how you, as a portfolio manager in fixed income, how you have adapted to this new environment and what you're doing differently in portfolios.
A core philosophy of the process in my team is that managing to an index-based approach to managing sovereign bond portfolios leads to poor risk allocation. What I mean by that is the countries that have the most debt are afforded the highest weight in the index, and when they add to that debt, they are given a higher weight in the index. And we think that it's extreme. This can lead to a large amount of embedded risk, which is not necessarily compensated for. At the best case, it leads to a low level of diversification, and so we perform a screening process which looks to identify those sovereigns with weak or deteriorating fundamentals and systematically exclude or reduce our weighting towards them, whilst also allocating a higher weighting towards those countries that have strong or improving fundamentals. Practically, this often leads to us excluding things like the European periphery, whilst having a larger allocation to countries such as Norway or New Zealand. And so effectively, this allows us to cover ourselves for the tail risks of one of these countries coming under threat. Of course, with the issue of the US dollar and the US Treasury market, it's not as easy as saying that we could have the same sort of process going through that price mechanism. But that is a bigger concern, I think, for discussion across all market participants. And so effectively, we're looking to cover ourselves for the tail risks, the negative tail risks. But I'm interested to know, Nanette, what do you think could be the potential positive outcomes that could come from this? Because we've covered a lot of how there could be negative outcomes.
Thanks, Martin, for that question. I do think that there could be a positive scenario, and that has been, in fact, accelerated by the pandemic, which is that the governments in developed markets they really bump up government investment in where investment has been running very, very low over the past 2 decades, and they put it into efficient uses of capital that actually also bump up potential growth while escaping the vicious cycle of too much money velocity and inflation. So if you can increase potential growth and increase productivity, that is really the magical recipe for growing the GDP pie without increasing inflation. And what we've seen is that governments in developed markets are making those investments. They're making it in infrastructure and in green investments. Now, the jury is still out whether those investments will in fact be efficient uses of capital and how those resources are utilized. But that is at least a hopeful sign that maybe these investments could increase GDP and could increase global productivity. Now, in that scenario, we obviously get different outlooks for asset classes. Unfortunately, in credit, it's still negative from the standpoint of you'd have real rates going up, and that would adversely affect government bond prices. On the credit side, though, it is positive. You'd have tighter spreads, and the key is whether tighter spreads would compensate for the rise in government bond yields. On the equity side, it is a definite positive. That kind of environment would increase discount rates, but equity risk premia would go down. In that environment, we would be looking at more cyclical sectors. And of course, the regulatory environment would be much more favorable to investors, and therefore even regulated industries in telecom, in banks, in utilities would be allowed to earn a higher return on equity. So we are coming to the end, but before we wrap up, Martin, I'd like to know, we're talking about a 5-year or longer time frame. What signals are you going to be watching to assess the environment and whether we're moving in the positive or negative direction?
Yeah, so I think the path for inflation for the next 1 to 2 years is going to be particularly key, and how that interacts with the currency, as we've discussed, as well as inflation expectations. There's a lot of discussion about inflation right now, whether this is transitory or whether it's something that's more sustainable. And so any evidence that we see towards those two extremes in the next 6 to 12 months is going to be key for identifying the tail risks here. And also keeping an eye on not only government policy surrounding infrastructure investment, but also private sector investment, which in many areas has been underwhelming in the last 10 years, also in this low inflation environment. So if those were to look more optimistic, then that would lend sway to the argument of the positive side.
Thanks, Martin, for sharing your thoughts. We are now going to wrap up the EMification of DM and turn it over to Tom Falago to talk about the digitization of money.
Thank you, Nanette. I am Tom Falago, and today I have the pleasure of interviewing two of our investors, Ranjit Ramachandran and Erin Harrington, who helped lead the research into our next topic, which is the digitization of money. Part of that was looking at cryptocurrency and blockchain, two areas obviously getting a lot of attention today and investment. So to begin, Ranjit and Erin, can you provide a little background on your inspiration for looking at this topic and why it's important to you? And we'll start with Ranjit.
Thanks, Tom. As an equity analyst covering technology stocks, I was first drawn to this area in mid-2017 while working on AMD and NVIDIA, two semiconductor stocks that supply graphic processing units into Ethereum mining. This led me down the crypto rabbit hole, figuring out what a hash rate meant, what is a smart contract, and so on. A central theme in technology is digitization of everything. And given money is such an important part of our daily lives, it is natural that money would be digitized too, and hence our topic, digitization of money. Further, software eating the world is an oft-repeated phrase in technology. Public blockchains such as Bitcoin combine open source software engineering, game theory, and cryptography in a powerful way, all of which drives my keen interest in this space.
So Tom, the inspiration for me taking on this project is really twofold. Professionally, I work on a global portfolio as a team analyst covering both financials as well as payment stocks. Over the last couple of years, we've had more and more conversation around B2B payments. B2B payments are still very antiquated. They're very paper-based and they're ripe for disruption. So I thought blockchain could be an interesting subject to explore in that it may change and revolutionize how we think about payments going forward. Secondly, and more on a personal note, I'm married to a musician. And over the last few years, that's led me to learn more and more about the creator economy. In particular, non-fungible tokens. These so-called NFTs are changing how we think about transparency and monetization of content. And I think that will have broader implications for the entire financial sector over time.
Now, Erin, funny you should mention NFTs. It does seem like everything NFT related today quickly becomes worth millions. It does have me considering creating my own portfolio of digital art. I could see at least one issue with that, though, and that is that I have absolutely no artistic ability whatsoever, which could be a limiting factor, but we'll come back to that if we have time. So instead, let's pivot now to the two of you who have actual skill, and I'll start with Ranjit on crypto. So, early on, a lot of the interest in crypto seemed to be retail and kind of niche investor related, but over the last 12 to 18 months, we've certainly seen a big shift towards institutional interest and actually people allocating to it. What do you think has really prompted that shift?
Yeah, so I would say a few things. So firstly, macro investors were among the first institutional investors drawn to Bitcoin. They are attracted to Bitcoin because of its fixed money supply, fixed at 21 million coins for all of eternity, which stands in stark contrast to the rampant money printing by central banks the world over. The money supply of the US dollar alone has increased over 5 times since Bitcoin was created. So macro investors look at Bitcoin as an inflation hedge, a digital gold for the digital era. Technology investors look at the promise of disruptive business models based on the Internet of Value, which is a huge potential shift from the Internet of Information we know of today. Fintech investors see in Bitcoin a complete reimagination of the traditional payment stack. For the first time ever, Bitcoin made it possible to transfer value in a peer-to-peer manner without the need for a trusted third party in between. And finally, some institutional investors are drawn to the potential for uncorrelated returns and the benefits of diversification from adding Bitcoin and other cryptocurrencies to their portfolios.
So, in speaking of that, I know one of the areas of discussion around crypto is whether it should be considered a true asset class. I know you've thought a lot about this. What's your view on it?
Yeah, so we came to the conclusion that crypto does form an asset class of its own, though clearly it is at a much earlier stage than traditional asset classes such as stocks, bonds, commodities, or currencies. Our asset allocation team looks at several characteristics for what constitutes an asset class. Characteristics such as investability, acceptability, and fundamentals. This translates into metrics such as size, liquidity, institutional acceptance, and diversification. So, for instance, the total crypto market cap is just under 2 trillion US dollars, which is already comparable to the high yield bond market and not that far from the small mid cap stock market. Liquidity has grown a lot in this space and is comparable to that of many large cap technology stocks or the so called FANG stocks. There is growing institutional acceptance, as we have seen from institutions such as MassMutual, PayPal, Square, Tesla, and several others. And finally, there is the portfolio diversification benefits. There are studies that show that a small allocation, say of 1 to 3%, can improve Sharpe ratios significantly.
So, I know another area of debate and a question we get asked a lot about is valuation and how do you even value a cryptocurrency and what frameworks or metrics might you use? I know you've also thought a lot about this. What's your perspective on that, and where do you think crypto is going?
So at the outset, I would say that valuation in the space is an unsolved problem. There are several cryptos such as Bitcoin and Ethereum that do not generate earnings or cash flows for their holders. And so the traditional valuation methods, such as we use for stocks and bonds, do not directly apply here. So one method that seems to be the most reasonable to us is the percentage of gold store of value method. Gold is believed to be about 10 trillion as an asset class, and Bitcoin, as of this morning, is about 700 billion. So you can make an assumption of what percentage of the total gold store of value use case may be addressed by Bitcoin and thereby get to a target price. Another method that has found a lot of following is the stock to flow method, popularized by an anonymous contributor named Plan B. We discussed this with our commodities experts, and it appears there are many questions still on the model based on the assumptions that go into it. In conclusion, our sense is that while it is hard to have a precise price target on a cryptocurrency based on what we know today, there is the room and the potential for the price to be much higher than where it is today, just based on the low levels of penetrations currently.
Let me pivot to Aaron now and blockchain, which is the technology underlying what's going on in crypto. Can you provide a little background on what it is and what the potential benefits are?
Absolutely, Tom. So blockchain technology in its simplest form is a shared truth that sits on a distributed ledger. I think there's a wide range of applications for blockchain over time, mostly concentrated in areas with high degrees of friction and complexity. Just as an example, let's think about a global supply chain. In one transaction, you're moving 3 different flows: goods, money, and information. Within each of those flows, there are also many intermediaries. It's highly complex and highly manual. Just to put some numbers around that, McKinsey estimates that 6% of global GDP is tied to transaction fees. It's a pretty staggering figure when you think about all of that in some way involved in an inefficiency.
So, understood. So how about outside of the payment and supply chain space, do you see other areas that are ripe for adopting blockchain?
Absolutely, Tom. So I think there are a number of technologies that springboard out of the blockchain. And one example of that would be smart contracts. Smart contracts can be implemented to automate processes once a transaction sits in a blockchain. For example, with COVID in mind, I think we're all more mindful of air quality than ever before. if we moved rental agreements into blockchains, automatic adjustments could be made to rental payments based on indoor air quality. Now that's a really simple example, so let's think about something more complicated, like non-fungible tokens or NFTs. NFTs allow for perfect record keeping across any asset class and across borders. They also democratize ownership of assets by offering fractional ownership pieces of tokens. Most importantly, they challenge how we think about the value of content by creating scarcity in digital assets. When you pull all of this together, I think there are implications for the consumer. We may not all be artists, but we do create data, and that data is valuable to a number of market participants. As we shift into this creator economy and NFTs become more mainstream, consumers may be able to bring back the control of their data and monetize that information.
So do you expect then, given the potential significant benefits, are there trade-offs? I mean, do you expect sort of the world to move to blockchain, or are there other ways to come at these issues?
There are definitely trade-offs, and I'm not suggesting that the entire world will move to blockchain. In fact, some industry participants say that blockchain is the mortal enemy of artificial intelligence. What does that really mean? Blockchain offers us perfect information, but our existing software solutions oftentimes offer us near perfect information. So when we think about that trade-off for blockchain implementation, we need to weigh the cost of blockchain adoption, the inertia that resides in our existing systems, as well as the functionality of our existing systems. Let's think about a credit card company as an example. They're able to detect fraud at nearly perfect rates, and that's using their own internal software, not a blockchain. They probably don't need a blockchain. So when we think about blockchain implementation, we should be focused in areas where the transaction costs are high enough to warrant starting from scratch with a new system.
Great. So let me pivot back to Ranjit now, and a topic that ties crypto and blockchain together, which is central bank digital currencies, or CBDCs. So a lot of increasing discussion about this, I think prompted by or really accelerated by China's release of their own central bank digital currency. So Ranjit, how important a development is this, and do you expect other countries to follow suit?
Yes, absolutely. So we believe that CBDCs are a matter of when and not if, and they will likely be a complement to the existing financial system and not really become a disruption. As CBDCs represent a direct claim on the central banks, just like the physical cash in your wallets, and unlike money that is in our bank accounts that are a claim on the individual banks. So in most well-functioning financial systems, the distinction is not that important. We think countries the world over are still likely to continue working on these projects, as CBDCs could be a significant accelerator to fintech innovation. Regarding China CBDC, China has been working on a CBDC project for several years now. Their goals are believed to be enabling the internationalization of the renminbi, the potential real-time monitoring of the economy, promoting innovations, and so on. The US and the developed economies have been quick to take notice. Just last week, Chairman Jay Powell released a video statement about a Federal Reserve discussion paper that is expected to be released this summer on the topic.
Great. So, okay, last question then, and my favorite. So you've looked extensively at the space and done a ton of research. What do you each see as the most meaningful investment conclusion that you drew on from the research, and related, what are you most excited about in these areas as you look out 3 to 5 years? And let's start with Erin.
Absolutely, Tom. So from the research, I'm most excited about the growth opportunity available to the neobanks. You may ask, what is a neobank? And when I think about neobanks, I'm talking about trusted financial institutions that offer up a digital financial wallet. So obvious examples of that would be Square or PayPal. Now, Ranjit alluded in his first question to this idea of the convergence of the Internet of Information and the Internet of Value. As these worlds collide, I think there are profound implications for the total addressable market available to neobanks. In the past or today, we've been able to manage our finances, our payments, our savings, our investments, our taxes, etc., within these applications. But in the future, they could offer us solutions for shopping, brand communication, travel data, identity information, and password storage. In essence, it opens up the door for them to morph from financial wallets into information wallets.
So, my conclusion is that the role of the rent seeking middleman is likely to be greatly diminished as value moves more and more to creators on the one hand and the end customers on the other. I'm very excited to see how the new Internet of Value develops over the next several years. It feels a lot like the early 1990s when the Internet of Information was in the early days and Google and Amazon and Facebook were not born yet. I'm curious to see where the next multi-trillion dollar enterprise based on the new Internet of Value is going to come from. Could it come from just Bitcoin becoming the preeminent store of value in the world? Could it be decentralized finance? Maybe it comes from NFTs or something entirely different that nobody has thought about yet. I sure can't wait to find out.
Great. Well, exciting stuff. I will say that I'm a little disappointed that neither of you mentioned my digital art portfolio as something that you were really excited about, but we can talk about that offline. And for all of those who joined us, thank you very much for your time and look forward to continuing this conversation. Take care.